Good evening, one and all. Thanks very much for coming along. I'm going to keep it fairly brief, but the two things that I really do want to cover, as Richard mentioned, is firstly taking investment from a global perspective and how, but also the very word investment and whereby we're taking a longer term view. And there's a pictorial at the end which hopefully will stick with you. Now, at any given time, of course, one of the old market adages is that bull markets climb a wall of worry. At any given time, there's a lot of moving parts, there's a lot of things to consider. We're certainly in that phase now in the UK, but as we'll come on to in a moment, we're also in that phase globally. So before I start, what I'd really like to know is that you've all got keypads or clickers about you. And I'll be really interested just to see which of the following four events you're most concerned about. The options are the B word, US-China trade war, it's all noise and I'm not concerned, long term, or something else. So there's the summary of the four choices. If you can just press your buttons, please, whenever you're ready. That's really good. Just by way, if we can leave that slide up for a moment, just by way of comparison, we did this in December and January. In December, Brexit was 46%. In January, it had gone down to 35%, so we're still in the same ballpark. The US-China trade war was 24%, rising to 27% in January, so that's obviously come off. I think that's really very good news in terms of what I'm about to say, that a third of you think it's all noise. That was just 22% in December. If you cast your mind back to the Santa rally, which never materialised, December was a pretty tough time. Equally, January was a pretty good month. So that went up to 26, and there you are, 35% today. And other could be any number of sort of things such as the Italian debt crisis at the moment, but certainly not a major worry for a lot of our customers and clients. So if we could return to the presentation, please. We asked the question in December, looking ahead to 2019, would 2019 take the biscuit? You can see there how we came to that acronym. And basically, there was a stage last summer when a number of international investors were asked about the UK, and they said basically that the UK at the moment, because of Brexit, is uninvestable. And of course, one of the things that came out of that is to disregard some of the quality that we've actually got just within the FTSE 100, for example. In terms of the global perspective that we've already mentioned, if, for example, you wanted exposure just within the FTSE 100 to the States, there's the pharmaceutical companies, the likes of GlaxoSmithKline and AstraZeneca. Obviously, the oil companies are well represented there. The Prudential are a company which has got big access to the baby boomers who, like in the UK, are now looking at their retirement needs. And even the old plumbing company Wolsey, which is now known as Ferguson, does a great deal of its business in the States. Then you can move on to China. How do I get exposure to China without leaving the UK? Again, China's the major engine of global growth, and we've got mining companies in the FTSE 100. Despite today's wobble, Burberry, for example, relies quite a lot on the Chinese consumer. Again, going back to pharmaceutical companies, because of the way that the culture is changing in some of the Asian countries, they're moving slowly towards Western medicine, and obviously that's a potential growth area there as well. Not to mention, of course, the likes of the banks, Standard Chartered, HSBC, very well established in the region. So without going too far, you can pretty much get access to that global perspective. Not only that, if you think about the US markets, on average, the dividend yield in the US markets is somewhere around 2.2%. It's not necessarily something that they're really into the way that we are in the UK. In fact, I saw something yesterday saying that there's only 2 markets in the world which yield on average more than the UK, one of which is Australia. The average dividend yield at the moment for the FTSE 100 is about 4.5%. And given where we are in the current interest rate environment, that's obviously an attraction of itself, quite apart from the potential growth we've got in there as well. Because, of course, if you look at even the consumer staples sector, which accounts for about 16% of the FTSE 100 by market cap, some of the names you will certainly know there, because they do give you that defensive element regardless of what the wider economy might be doing. The likes of Unilever, the stuff we've got to eat and drink every day, the supermarkets, even, dare I say it, British American tobacco and imperial brands as well. So you've got any given number of choices between these companies which tend to be cash generative, stable, usually throwing into the pot a decent dividend yield, and that's without leaving the market, the FTSE 100. It's just something to bear in mind, because we have these other things. At any given time, there is a great deal of noise, but we need, where possible, and it's easier said than done, to step back and see where we're going and the quality of the companies that we're investing in, as opposed to some of the macro stuff. Interest rates have come to a juddering halt in terms of being hiked in the States. The Fed seem to be backtracking a little on the strength of the US economy. There have been some concerns in terms of recent economic data, especially house building and retail, that perhaps, just perhaps, we're getting to the thin end of the wedge of something like an economic slowdown. And of course, an economy like the States, where 70% of GDP is driven by the consumer, that's quite a big deal. Having said that, one of the reasons we had a good January was because the Fed became a bit more dovish, a bit less likely to hike interest rates in 2019. Probably leading up to the end of last year, the consensus was we would get 4 rate hikes. The current consensus in the States is that we'll get none at all. Sterling, again, this has been on something of an upward trajectory in recent months, mainly around it really still being the Brexit barometer. It's still only sort of 131, 132 against the dollar. And another interesting side effect of that, of course, is that we've got this situation where it's estimated that in terms of FTSE 100 companies, probably 70% of their earnings come from overseas. So what we actually want in terms of just a kind of binary relationship is weaker sterling, all things being equal, share prices will rise. However, what's happening at the moment is that the FTSE 100 has managed to put on about 6% this year, which is a good performance, but sterling's been quite strong as well. But there is still a correlation between what sterling's doing inevitably and how that impacts on the FTSE 100 companies. China, US, well, this of course is a big one. When we get to the T, we'll know that the president is now going to focus his eyes on India as well, as if China wasn't enough to deal with in one way. Now, there's an interesting couple of things come out of this. We had some pretty weak data coming out of the States today in terms of their trade deficit. Part of the reason for that could be that the currency market, which is a zero-sum game, the dollar's been strong for some time. So part of the reason for that is that American stuff is more expensive for foreigners to buy. However, the other thing that might be coming out of that perhaps this deficit is widening because the US-China trade spat, which the US initiated, is hurting some US companies and therefore the economy. And another thing, and this will become apparent one way or the other in the next few months, is that in terms of China, this trade spat may have resulted in some kind of surge of patriotism. That is to say, we heard a couple of months back that Apple was starting to struggle in China. Potentially that's local consumers moving to Huawei, despite whatever difficulties they might be going through at the moment. And more recently, over the last week or so, Ford as well. So that could actually be, if one thing was known from the start, is that generally speaking, trade wars are good for no one. And we had globalisation being accepted as being good for everyone. So that will continue, as it does at the moment, on a daily basis to alter market sentiment. Inflation at the moment, the one to watch here in both the UK and the US is probably the growth, real wages growth. That's normally the button for central banks to get involved, raise interest rates to keep a lid on inflation. And of course, the man himself, he can be market moving, rightly or wrongly, just by sending out a tweet. And the fact that we have what seems to be several hundred tweets from him on a daily basis means that there are elements of people getting desensitized to this stuff. A lot of it, of course, is political. He shouts from the rooftops when the Dow's up and you hear a bit less. Certainly, when I left the office today, we hadn't heard anything about the trade deficit. So there you have it. So in terms of globalisation, that's where we are. But if I could ask you to go away with one thing from this brief speech, it's taking the longer term view. That's goes up to 2016, but you get the picture. It's over a 70-year period. Just a couple of bumps in the road that we've seen there. If you sort of guide your eyes towards the mid-70s, that was the oil crisis. All sitting there in candle lights, 3-day weeks, and all the rest of it, although most of you don't look old enough to remember that. In terms of 1987, that was the stock market crash. Where's it gone? In terms of 1999-2000, that was the dot-com bubble bursting. And in terms of 2008-9, that was the financial crisis. You will have heard any number of great expressions. Warren Buffett's mentor, Benjamin Graham, said that in the short run, the market's a voting machine. In the long run, it's a weighing machine. Buffett himself says, I only invest in stocks I'd be happy to hold if the market closed for 10 years. And as private investors, this is partially what you're up against, quite apart from the noise that we've been talking about. There are professional, institutional investors with different time frames in mind. It might be a daily time frame. They might be taking a 1-month view. They might be taking a 6-month view. That's a rounding error in terms of time over the longer term. And I think on that basis, it's taking that longer term view as opposed to over-worrying around what's happening on a daily basis. I think Moira mentioned earlier that we've got a Q&A panel at the end, so by all means, park your questions if that's okay. And without further ado, I'll pass you over to Maura O'Neill. Thank you.